Hola mi gente and welcome back to the channel. This is Sean from We Are Investing, a channel that is dedicated in investing and personal finance. What are we going to be talking about today, mi gente? We're going to be talking about options trading on Robinhood. This video is tailored towards someone who wants to learn how to start trading options. We're going to dive into what options are. We're going to go over the basics when it comes to options trading. And then we'll show you how to buy and sell calls and puts on the Robinhood application. So at the end of the day, if you're someone who wants to get involved with options trading, then this video is definitely for you. Now, this is not the first step. The first step in order to trade options is you have to be approved for options trading. Now, I did a video on this the other day. I'll provide a link down in the video description. In that video, we go over how to enable options trading on Robinhood so that you can get approved and so that you can start trading options on Robinhood. So that is the first step. If you haven't done that already, then definitely check out that video. But if you've done that, and also, in my personal opinion, my recommendation is that you need to know how to trade stocks and you need to understand the stock market before you dabble in options trading, because with options, there's additional risk, but that risk can also increase your profits. It's a great way to leverage your money and to maximize your returns. Now, by the end of this video, I'm going to cover a lot of stuff when it comes to options trading. I don't expect you to retain all of that information, nor do I expect to be able to go over everything regarding options in one single video. So if you have any questions, you can always reach us on the Discord, which you get access to if you join the Patreon. A link is provided down below. Now, the reason why this channel is called We Are Investing and not I Am Investing is because I firmly believe in creating a community of like-minded individuals where we can learn together, grow together, and make money together. And on the Discord, it's essentially a huge chat room where we talk stocks, cryptos, investment opportunities every single day. We spread the knowledge. And in that community, we are definitely growing together. And that is the best way to gain knowledge when it comes to investing, in my personal opinion. So without further ado, let's dive into what options are. And then we will dive into how to trade them on Robinhood. Let's get this process started, mi gente. So the first thing, what is an option? What are options? Well, an option is a contract that gives you the right but not the obligation. You don't have to follow through on this contract to buy or sell 100 shares of the underlying stock by a certain date. Now, in any contract, in any option, there's always a writer of the contract and a buyer of the contract. So the writer would be selling the contract to the buyer, and the buyer would be buying the contract from the writer. Now, this applies more towards different investing strategies, more complicated options trading strategies that we're not going to dive into on this video. For the purpose of this video and the basics, we are always going to be the buyer of the contract, of the option, and we are not going to be the writer. We will sell contracts after we bought them, but we will never be the writer. We will never be the initial seller of a contract. Now, because you have the right to buy or sell a certain stock at a certain price by a certain date, you have to pay for that right. And that payment is called the premium. That's how much you are going to pay for the contract. That's how much you're going to pay for the option. Now, the price that you can buy or sell 100 shares of the stock at, that is considered the option strike price. And the date at which you have the right to buy or sell 100 shares of the stock, that date is called your expiration date. Now, it's important to know that you can exercise, you can buy or sell 100 shares of a given stock anytime leading up to that expiration date, but you cannot sell or buy 100 shares after the expiration date. That is the deadline. You can exercise your option anytime before then, but after your expiration date is expired, your option is no longer valid. So essentially, in layman terms, an option is basically a speculative bet that you make saying, I believe a certain stock is going to go up or down by X amount, and you're putting a timeline on that bet. So when you invest or trade a stock, you're betting that the stock's going to go up or down, but the time does not matter. Options, you add that extra level to it. You're saying, here, I bet that this is going to go up or down by X amount, and I believe it's going to do it within a month or 2 months, whenever that expiration date is. You're adding that additional layer to your speculative bet. You're also saying you believe it's going to go up or down by X amount. So you have time and you have volatility. Those two factors are not included in stocks, but they are included in options trading. It's also very important to understand that the option market is a market within a market. You have stocks and you have options. People buy and sell stocks all the time. People buy and sell options all the time. Supply and demand is a factor in the options market, just like it's a factor in the stock market. How much is someone willing to pay for that contract that you hold, for that option that you hold? If there's a lot of people that are willing to pay and there's not many options out there, the price goes up, just like with stocks. So just know that it's a market within a market, and you can always trade your options. You don't have to hold them until expiration date. You don't have to ever exercise them. You can always trade them to somebody else. Or at least if there are buyers out there that want that option, then you can always trade. Because sometimes you might get into an option that not a lot of people are interested in, and then you're going to have a very hard time selling that option. We're going to dive more into this in this video as well. So now that we have a general understanding of what options are and how they work generally, let's dive more into this. Let's head on over to Robinhood. This is your home screen, and let's see how to buy and sell options on Robinhood. So the first step is to search for a stock, to search a ticker. We're going to search AMC. Now, to get into the option side of things, you're going to hit Trade AMC Options, and then this is going to pop up. Now, this is called the options chain. Now, this will look a lot different on different brokerages. There's more information or less information, depending on the brokerage, depending on who you are using to buy and sell stocks. So Robinhood is a great place to start learning. It's very simple. There's not too much information in here, so that you don't have information overload. You don't have paralysis by analysis. However, I no longer use Robinhood to buy and sell stocks. I learned how to do so on Robinhood, but I have then since switched. Use Webull and Thinkorswim. There's more information. But this is a great place to start learning because it's very easy to use. It's where I learned, and it's where a lot of people are going to learn how to buy and sell options. So, in my personal opinion, although Robinhood might not be the best brokerage out there, it's a great place to start learning. This is what the option chain looks like on Robinhood. Now we're going to go over some more terminology, and then we'll dive into some more detailed stuff. The first thing is that when you start off investing or trading options, do not sell a call or a put before you actually have one. If you sell a call before you have a call, that means you are the writer of the contract, and that means you have more obligations, and you could lose a ton of money if you do not know what you're doing. So for the basics, make sure that before you open up any position, you are always on the buy side of things, and you could do a call or a put. Now you might be asking, what is a call and what is a put? Now remember that an option is the right to buy or sell 100 shares of a stock by a given date. The call is the right to buy. This is when you're bullish on a stock and you think the price is going to go up. A put is the right to sell. So you think the stock is going to go down. Call gives you the right to buy 100 shares at a given price, and a put gives you the right to sell 100 shares at a given price. Now, when we take a look at this options chain here, right, and we're looking at AMC, and you can see that the current share price for AMC is $54.22. Now, there's another terminology that I want to throw your way, and that's in the money versus out of the money. Basically, what this means is that the strike price is below or above the current share price. Now, the strike price is the price at which you have the right to buy or sell 100 shares. Any strike price that is below the current share price, in this instance, the $54 strike price, the $53, all the way down, is in the money. Any strike price above that is out of the money. Another thing here to understand is that expiration date, at which date you have the right to buy or sell. Any date after that date, you no longer have the right, and any day before this date, you still have the right. So for this one, you have an options chain. We're on the buy side of things for the call, the right to buy by July 2nd. Now, if you look at this options chain and you go through the expiration dates, you're going to see that each expiration date is out a week. They always expire on Fridays. There are a few rare cases where they do not, but 99% of the time, your options are going to expire on Friday. And another thing that you need to understand is you cannot trade options in extended hours. Options trading only occurs from 9:30 a.m. to 4 p.m. on Monday through Friday, whenever the stock market is open, excluding federal holidays. So let's take a look at this options chain even more. So let's say you think AMC is going to go up. You think AMC is going to go up $10 this week. So by July 2nd, you think that AMC is going to hit $64 a share. So you're bullish on AMC, so you want to buy calls. Let's say you want to buy the $54 strike price. That gives you the right to buy 100 shares of AMC at $54. How much do you pay for that right? Those are your premiums like we discussed earlier in this video. Right now, they're $4.63. Now, an option contract is a right to buy or sell 100 shares. So you need to times the premium by 100. So you would be paying $463 to have the right to buy 100 shares at $54. So that means that your break even, because of how much you paid for this right, how much you paid for this option, would be $58.63. If AMC expires at $60, you make money. If AMC expires, or the share price of AMC on July 2nd at market close is below $58.63, you lose money. So let's say that AMC was to hit $75 by the end of the week, and you bought this options contract for a strike price of $54. Well, 75 minus 54 is $21. Times 100, because you have the right to buy 100 shares, is $2,100. Minus how much you paid up front in premiums of $463, you would have made $1,637. The reason being is because you have the right to buy 100 shares at $54, and you can instantly sell those shares at market value. So you buy them at $54, the current price is $75, you sell them right away, and those are your profits. Now you can let the option expire. If you have money, then you can take physical delivery of 100 shares at $54, and maybe you think, well, I don't know, AMC can continue to go up. You don't have to sell them right away. But that's how much money you would have made if you sold them right away, or if you sold your option right before it closed. Now, on the flip side of things, if you think a stock price is going to go down, then you're going to buy puts. And the way this works is this gives you the right to sell 100 shares at a given price. So let's say we buy a contract at $54. We have the right to sell 100 shares of AMC at $54. Let's say that AMC drops to $25. How much money would we make off of this contract? Well, if we have the right to sell 100 shares of AMC at $54, and the stock is currently trading at $25, well, that's a 29 difference in stock value. So that means we are able to sell at a much higher price than it is today. And that's how you would make money. So your total gain would be $29 a share times 100 shares, because that's the right. And you have to pay a premium for this option. In this case, it's $4.73 times 100. So $473. Your total gain would be $2,427. So that is how calls and puts work. Now, there are some more things we need to talk about, right? Because it's not just as simple as if a stock goes up, I make money. If a stock goes down, I make money on calls and puts. Now, remember how we talked about how options is a bet on a stock going up or down, and you're also adding a timeline to that bet. Because of that timeline, you can have a case where a stock can stay flat, and you actually lose money on your options. Because each day, as you get closer and closer to the expiration date, the odds decrease and decrease because time is not on your side. So let's hop back on over to the call side of things. And let's say let's go out a couple weeks. Let's say by September 17th, and let's go back up to a stock that's out of the money. Let's say by September 17th, we believe that AMC stock is going to be worth $60. Now, notice how high the premiums have gone in AMC stock. And that's because we pushed the date out further, meaning that the odds are in our favor that the stock price can go from $54 to $60. Now, AMC is an extremely volatile stock. And because of that volatility, the chances of it going from $54 to $60 are much higher given this time span. And that's why you're going to pay more in premiums. Notice how we are going to pay $17.75 in premiums for this contract. And the prior contract, which was a week out, we paid around $4. So this is much more expensive. But what I want to talk about here, and I want to talk about a couple things. If you click on the actual options contract, you're going to get the stats and the Greeks. Let's just dive into all of this right now. The mark is basically the middle between the bid and the ask. The bid is how much people are willing to pay for this options contract, and the ask is how much someone is willing to sell this options contract at. So we have 25 contracts that are willing to be purchased at $17.50. We have one contract that's willing to be sold at $18. So therefore, your mark is $17.75. That is the middle. Now, when you get into purchasing options, you want to be as close to the bid as possible. Sometimes if it's too low, you won't be able to buy the option. But you don't want to pay what the ask is either, because then that means you are not meeting in the middle with the seller. So you want to try to pick a price that is closer to the bid. Maybe it's at the middle and a seller is willing to come down and meet you at that price. Pay what you're willing to pay. Do not move up too high, and never pay the ask, because that means you are not letting the seller move at all unless you need to get into this options contract. Now, another thing that you need to consider is volume and open interest. Volume is how many options were traded on a given day at the strike price. Open interest are how many options are open, how many people actually own this contract. How many contracts are actually owned, I should say, because not 7,302 people, it's 7,302 contracts, and you can hold more than one contract as an individual. So if you have decent volume and open interest, and let's say the stock was to go to $80 next week and you want to lock in your profits, you don't want to wait till September 17th, because if you wait, the stock can drop back down and you can lose money. So you want to get rid of it when it goes up. If there's no volume and there's no open interest, it's going to be very hard to sell that and to lock in your gains. And you're going to be stuck holding this until expiration date. So volume and open interest, you definitely want to check out, because you don't want to get stuck holding an option and not having the capability of selling it when you want to. So always make sure that the price you're willing to buy an option is closer to the bid, somewhere in the middle is acceptable, but don't give the ask right away. And also make sure that there's decent volume and open interest so that you are able to sell it when you please. Now, the Greeks are going to give you some information on how an option would behave given a change in the share price. Now, Greeks are changing every single day. And as you get closer to expiration date, some of these Greeks are going to get higher. Now, delta corresponds to the change in the option price corresponding to $1 in the share price. So for instance, let's say that AMC, which is at $54.22, was to move up $1 to $55.22. Well, what would happen to the options value at that point? Well, for every dollar, based on this delta, the premium would go up 64 cents. So let's say it went to $55.22. Your delta, or because of your delta at 0.64, the new price would be $17.75 plus 64 cents. If AMC was to drop $1 and go to $53.22, your premium would drop 64 cents. So delta is the change in value of your option given a $1 change up or down in the stock. Gamma, we're not going to talk too much about. Gamma is basically the rate of change for delta. As delta changes, gamma changes as well. You don't really need to worry about gamma too much. Theta is a very, very important one. Because of that added layer with the option, that timeline we're talking about, you can have a stock that stays flat and your option would actually decrease in value. Because remember, each day that passes, you're getting closer to expiration date and the odds of your bet happening decrease. So theta, because it starts with T, this is time decay or theta decay. This corresponds to the decrease in value of your option given each day that passes. So tomorrow, this option would lose around 12 cents, 0.1155 each day. And as you get closer and closer to expiration date, this value will change and it's going to go up depending on where the stock is. But right now, the theta is 0.1155. So tomorrow, this would lose around 12 cents in the premium. So that's also very important to understand. The other two Greeks, I'm not going to dive into too much. The Vega is based off of volatility, and that's all you really need to understand. The two Greeks that you need to know are delta, which is the change in option price given a $1 change in the stock price, and theta, which is the decrease in option value each day because of time decay. Because AMC is such a volatile stock, the premiums are so high. Because with volatility is good for options. It means it's going to increase your premiums because the likelihood of an event happening in the share price going to $54 to $60 is very likely given the volatility of the stock. But let's say we look for a stock that doesn't have as much volatility. A stock that I like is somewhat volatile, but nothing like AMC. CHWY. This is a company that I love long term, and I have options in CHWY. And I'm going to give you a general understanding of what I'm doing in CHWY so that you can understand what's happening. I'm going to show you something that I love in the stock market, and these are called leaps. Now, leaps are essentially a call option that is usually in the money, so below the current share price, and very far out in expiration date. Leaps are call options that won't expire for quite some time. So I have them for January 20th, 2023. Now, the reason why I love this is because this is a great way to leverage your money if you believe in a stock long term. For instance, the current share price is $80.38. If I wanted to buy 100 shares at the current strike price, I would have to pay $8,000. But let's say, this is true, I am very bullish on CHWY, and I think that in a couple years, the stock is going to be worth well more than $80 a share. How can I maximize my potential profits if this was to happen? Well, the first thing, the way that I like to do it is with leaps. Now, I don't go 100% in leaps. I also own shares, but I definitely add leaps to my long-term positions. And the reason being is because how I can leverage my money. So for instance, if I think that CHWY is going to be much higher than $80 a share, let's say my price target is $200 a share by 2023 for CHWY stock. Well, I can get exposure to $100 a share. The premium right now is $20.53. That's per share, and each contract is 100. So that's $2,000. So instead of $8,000, I only have to pay $2,000 to have access to 100 shares. So in theory, I can, if I use that same $8,000, let's say I had $8,000 available to invest in CHWY, I could have access to 400 shares instead of 100 shares. So I 4x my exposure, and that's how you leverage your money. But there is a caveat to this. This is something you need to understand. You're paying for that right to have access to 100 shares per contract. So in theory, if CHWY stayed at $80, I would lose all of my money. My break even would be $100.53. So I need to believe that CHWY is going to be worth more than $153 in a couple years. And if I'm wrong, then I'm going to lose all of my money. And if I just held the stock and the stock stayed at $80, I would have lost no money. But if it was to move up, I would have made much less money. I would have made just worth 100 shares when I could have had exposure to 400 shares. So you need to be bullish in leaps, and you need to think that the stock is going to move up. And there's also situations where you can get into a leap and you can actually pay less than what the current share price is. Let me explain this one real quick, and then we're going to wrap up the video because I think I'm giving you a lot of information right now, and I might be losing some of you at this point. So let's go to trade tell options. This is a liquid natural gas company that could be really good long-term, and I looked at this the other day. Let's go to leaps, right? For January 20th, 2023. The current share price is $4.40. Let's say I have the right to buy 100 shares at 50 cents. That's the leap here, right? So this is an expiration date. That's January 20th, 2023. Let's go. $3.85 in premiums for this call option, plus 0.05. Nope. $3.85 plus 50 is $4.35. That is my break even for this stock, for this option. The current share price is $4.40. So with this leap, if this stock stayed flat all the way to January 20th, 2023, I would be in the money and I would make 5 cents per share. 5 cents per share times, 5 cents per share times 100. I would make $5. But I wouldn't lose any money like I would in the CHWY situation. Now, if the stock went down, I would have lost money. I would lose all of the premiums that I put in. Now, let's say that this stock actually does move up higher in price. This is a traditional leap where you're deep in the money. Let's say that this stock, I don't know, let's look at the chart. Let's see what their prior high was. Let's say that this stock was to go to their prior high at $17. If I go back to the options chain and I go to the leap, which is the one that's most out of date, January 20th, 2023, and I pick the one that's most in the money. So let's say that this stock does end up going back to its prior high at around $17. The strike price is 50 cents. So the difference between the strike price and the share price at expiration or any time before then, if the stock was to go back to its prior high, would be $16.50. Now, each contract gives me the right to 100 shares. So let's say I bought one contract. So that means I have the right to buy 100 shares of TEL at 50 cents per share. It's currently trading at $17. So the difference, $16.50 times 100, that is your gain, $1,650. Now, you also paid that premium, which is $3.85. So you got to subtract that, and that's per 100 shares. So that's $385. Your gain would be $1,265. You paid $385 up front. So you would 3x your return on this situation. And that would give you a better return than if you were to just buy the stock up front. It's a great way to leverage your money. Now, in this case, because the strike price is 50 cents and your premium's $3.85, you're pretty close to the current share price in all-in money. So your gains won't be that much more. But in a case where you're paying far less than the current share price, you would leverage your money even more, and it would be an even better situation. Okay, there's one thing I almost forgot to include this in this video, and that's how to actually create the buy or sell order. So like we said, you never want to sell something before you've bought it before, because if you sell something that you do not have, you are the writer of the contract, and you do not want to be doing that right now. So when you go to buy something, just make sure that it's always on buy. Unless you already bought something, then you can sell it. You can trade it, but you don't want to be the writer of the contract. So let's look at an option. We're going to do a call option to be simple. The same process applies for puts. You pick the expiration date. It's important to know what the expiration date is because this is crucial in your options contract. So we're just going to pick any of these, July 30th. So let's say I want to buy a call option for a $50 strike price that expires on July 30th. It's in the money because the current share price is $54.22. Let's take a look at what people are paying for this. The bid is $13.65. The mark is $14. The ask is $14.35. The mark is the middle. It's just the middle between the bid and the ask. Now, I don't want to pay $14. I want to play something that's closer to the bid. Maybe I want to pay $13.75. To create this order, you're going to click on this option. Then this is going to come up. You're going to hit continue. Now, each contract is worth 100 shares, like we talked about before. You can buy as many contracts as you want. My price that I want to pay is going to be $13.75. That's what I'm willing to pay for this contract. I don't want to pay the middle. I want to pay closer to the bid. I want to try to maximize my potential returns, and I also want to reduce the risk here as well. Now, your expires, you're going to have good today, good for day, or good till cancel. Now, remember, we said options only trade during market hours. They only trade from 9:30 a.m. to 4 p.m. Eastern Time. You can have an option. You can have an order waiting to be filled. And if you have good for day, once the day is up, once you get into extended hours, your order is going to be canceled. You're going to have to reopen another one the next day. Good till cancel means that you'll have your order pending and it will fill whenever that price is hit during market hours, because no options trade in extended hours. No options trade in pre-market or after hours trading. So you are suspect. You are exposed to the volatility that can happen in pre-market and after hours, and you can't capitalize on that, and you can't protect your position by selling. So that's an additional level of risk with options. Because at least with shares, if you're paying attention, you can enter a limit order. You can enter a position. You can enter an order to sell your stock if you start to see a drop. But with options, you are stuck. You can only change, you can only execute trades during market hours. Once you have all of your information together and you're ready to do this, you're just going to review your order and you're going to follow the steps and you're going to submit your order. And you'll get confirmation when that order is either canceled because the day expired and nobody filled it, or you'll get a confirmation that you have had a successful order. It's completed. Now, this is the same process for long puts. And it's also the same process for selling an option once you already bought it. We do not want to sell an option before you have it, at least not for this video, because that's a different strategy that I need to explain in further detail. But these are the basics, and this is the best way to learn how to buy and sell stocks as a beginner on Robinhood. But at the end of the day, options are a great way to leverage your money. Hopefully, I was able to provide you guys with some good information here. If I was, please consider hitting that subscribe button, ringing that bell, and smashing that like button. And like I said, this is something that's very complicated. It's something that takes time Do not be afraid to try getting involved in options trading, but just be careful. Take your time. Don't bet big amounts of money. And like anything in life, you got to practice. And especially when it comes to investing in the stock market, you're going to mess up, but you got to learn from your mistakes. And the most important thing is that you don't go too much in one position so that if you do make a mistake, you're able to live another day. Now, if you want to join the community, you can ask me any questions. You can ask the members of the Discord questions as well, because I'm only one person. I only have so much time. I can't answer all of your questions all the time. That's why it's great to have a community where you can ask the community questions as well. You can do so by joining the Patreon. I'm going to provide more videos on options trading. I'm going to try my best to try to teach you guys how to get involved in options, and hopefully you can join us on this journey. But with all that being said, it's a wrap. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.